Hello, this is Stacy Francis from Francis Financial. Today we're going to be talking about putting the Brexit vote into perspective. And I know for you, when you woke up this morning, you're probably pretty surprised by the news that, yes, the UK has voted to exit the European Economic Union. I do want to share just kind of a cute story to kind of bring a little levity to the whole situation. My children actually are part English, and so they are half English, half American, and this morning my husband and I sat them down and said we wanted to let you know that England decided to leave the European Union. And my son, who is 10, Sebastian, looked at me and had this just really puzzling face and said to me, but Mom, I don't get it. Like, how are they going to leave? They're in Europe. How are they going to leave? And it was again, I think just a really good thing for us to see, to know that while England cannot leave Europe, they are where they are. They can't pack their country and go. They're definitely going to have continued relationships with Europe. And I think what the overall message that we need to be taking from this vote and the results of it is that they do want continued relationships with their European counterparts, but they are concerned about certain areas. So what we're going to do today is we're going to go through all the different pieces that you need to know about with relation to your portfolios. So first, we're going to talk about why did the UK vote to leave the EU. Secondly, what is happening currently in the markets, and we put this presentation together, so it's very timely. In fact, this market information is only a few minutes old, so that's going to be really helpful for you. In addition, we put together a look at what is the true economic output for the UK, the outlook for the UK going forward. What about your portfolio? What should you be thinking about specifically with your positioning? And then also tips for successful investors. So let's go ahead and get started and go through some of this. So why did the UK vote to leave the EU? Well, there are many different reasons for this, and I think that also if you talk to certain individuals, they may have different views based on their political agenda and also how they voted with the referendum. However, one of the main issues that was brought forth was rules, rules, rules. This is a wonderful slide, and essentially it shows the regulation of the UK as well as many of the other countries that are within the European Union. And with this, you see on the far right-hand side, those countries that have more regulation, what you would call paperwork, red tape. And on the left, you see Britain. So what's interesting, even though they were very frustrated about the rules that were being imposed upon them by EU, overall you can see that they actually have less rules than you would think. Now, the other piece, we looked and did a little research to get a better understanding of how would it relate to, for example, the U.S., Australia, Canada, and is England particularly being held down compared to some of these non-EU countries? And overall, it suggests that they are no more heavily regulated than some of these non-EU countries, such as Australia, the U.S., and Canada. So overall, what we can take away from this is while they are hoping to get rid of a lot of red tape, overall they're not going to be able to tearing up many of those rules. Now, another major issue throughout this is immigration. And in fact, until about 20 years ago, Britain did not really experience a whole lot of immigration. And what the changes brought to them by joining the EU is that there was significantly higher numbers of immigration. And what ultimately arose was a backlash that started to filter into the British psyche. It's interesting, being married to my husband, who is from England. We are back in England, the outskirts of London, which is very cosmopolitan, where interestingly enough, my brother and his family live. And then we go out to the middle of nowhere, more in like the Midlands, where I call it the pitchfork community, more of the farmers, the rural agricultural. And we have a very different experience. The views are very different about immigration. I have found in those two different communities. And it's interesting because, well, we're going to actually look at who voted yes, who voted no. And you'll see that there are some very strong parallels that mostly in the cosmopolitan areas, such as London, they voted to stay within the EU. What we call the pitchfork communities outside of those cosmopolitan areas, the vast majority of those individuals ended up voting to exit. One of the driving factors is their concern about immigration and protectionism, anti-globalism coming in play. So a lot of this, you can see this immigration has occurred more heavily in the 2000s, and just peaking, as you can see, last year. So this is a lot of the issues driving this forward. So what's happening to the markets? Well, yesterday, I don't know if you noticed, but we definitely did. The market rallied pretty significantly because it priced in that the UK would vote to stay within the EU. So they were having their pre-party, but unfortunately, what ended up happening is something else happened. Investors were not prepared for the fact that, and they were were premature celebrations. So that is a challenge that we're seeing, and why we're seeing such big drops in the market today. So let's talk a little bit about the sterling. So this is the pound. Something that you all know already is that England does not use the euro. They have stayed with their British pound. Sterling is what you would refer to that British pound as, and sterling plunged about 10% down, which is actually its lowest level in 3 decades. So yesterday it closed at about 1.5, and today, with the hopes that again that the UK would be voting to stay within the EU, and it hit a low of $1.32. So this is great, however, for those of you who want to travel to England. We actually have a trip coming up in August. So from that perspective, you travelers, this is a great thing, because now your dollars are going to go much further, making a stay in England much less expensive. What does it mean for your portfolio? Well, for your international holdings that you might have, if they're not hedged, it means that all of a sudden you've made money. Why? Well, if they are in U.S. dollars, if they're held in U.S. dollars, and the dollar is now worth more, it means that you've all of a sudden gotten a boost in your overall return in that international investment. However, though, let's not forget, the stock prices have come down, and this is what you're seeing right here. So this is the Dow Jones Industrial Average. This is essentially as of the start. We saw that there was a massive drop. Since then we've actually we saw about in total about a 500 point drop, but we're seeing it recover, and you can see that drop right here, and you can start to see the recovery throughout the day, which is what we continue to expect. As I mentioned, we had that early pre-party in the market yesterday. Well, this is essentially the hangover, and you can see it's quite a hangover and quite a disappointment, but the market is starting to get more comfortable, also gaining more information about what does this really mean. And the less uncertainty there is, the more you're going to see the market recover. This drop right here and the volatility that we're going to see, I'll be honest, not just today, but most likely over the next several weeks and next several months, is really that uncertainty. The market hates uncertainty. I know I hate uncertainty. For example, when I go to a play, or I go to the airport, I get all my ducks in a row. I have my my passport ready. I have my tickets printed. I know when both the takeoff time is supposed to be as well as the boarding time. That gives me a lot of comfort when I'm traveling. But the uncertainty piece of maybe there's bad weather, for me, that really kind of upsets me. If I see there's bad weather and I might be delayed or might have some changes, well, the market reacts the exact same way. Uncertainty is something that the market really doesn't like. So let's talk about what does this mean for us for the long term and what's happening particularly with the FTSE 100. So the FTSE 100 is the 100 largest stocks, is definitely is a representation of the UK stock market. And it had plunged about 9%. You saw that we started to have some recovery, essentially as the panic calmed down and London's main index started to recover. So overall, it closed already today. It started with a 9% loss, ended up with a loss of only 3.2%. What's interesting is that the FTSE's losses were actually not as significant as we saw maybe had feared. In fact, some of the other European markets had greater losses throughout the day. So that was something that kind of surprised us. So what does this mean for the long-term outlook for the UK? Well, as far as right now, the Bank of England has come out and said that there's going to be no sudden moves and that obviously they're committed to offering financial stability. They're willing to put a lot of money into the system for further liquidity if needed. We've already seen that the UK growth has started to slow earlier this quarter, earlier this year. So far, the estimates of about a 3% growth. We're expecting that most likely it will be lower. I know that you've also seen in the news today that David Cameron announced his intention to step down as Prime Minister. When that came out, it is quite a headline. If anything draws you to another place of, oh my gosh, he's now resigning. Can you imagine, England is going to pot. Well, I have to tell you that part of the reason why he resigned is in his campaigning for a stay vote. He essentially threatened that if England and the UK in general, if they voted to leave, he would step down as Prime Minister. So to be honest, he kind of shot himself in the foot. He had to step down to really stand by his word of what he had said previously. However, there's already individuals jockeying for position to be the new leader. That new leader will take office in October, and David Cameron has definitely mentioned that he intends to steady the ship and very much wants to go out of his Prime Minister position in a very positive way. So we'll definitely remain committed to putting all these new trade accords and different implications in order as soon as possible. And so while we're talking about trade, I wanted to bring this up to you because this is actually what I think is one of the most important issues. The UK has a lot to negotiate, and they need to negotiate a new EU relationship. Essentially, they don't want to be burdened by European Union law. And they're bargaining with their governments to create these new trade deals does bring some uncertainty. And it's not something that's going to be done tomorrow, next week, next quarter. In fact, it's expected to take at least 2 years. Now, there is a lot of incentive for the UK to put these trade agreements in place sooner than later. Part of the reason that is important is because of that word, that key word that we're talking about throughout this entire presentation of uncertainty. Uncertainty is really, I think, one of the biggest challenges that they are facing. So the faster that the UK can put these trade negotiations in place with the countries of the European Union as well as outside the European Union, the more likely they're going to have less of a financial negative impact from what we're seeing today. Now, there is a concern there definitely is a concern that their trade negotiations may be somewhat stymied and be more challenging in the fact that the UK could definitely become a scapegoat to warn other countries who are on the fence about leaving the leaving the European Union. There are definitely certain facets of individuals throughout Europe that are very negative, just as the majority of the voters, as we saw, that turned out to the polls. So that's something that we do want to think about. There is some positives for Europe, positives for England. In particular, the UK is sending about £350 million a week to Brussels. I looked up to see how much money does that really constitute for the budget in Europe, in the UK. And to give you an idea, that £350 million is half of the budget that's allotted for the entire year for their education for children. So it's about $700 million that is given for education within the UK, and you can see that even on a weekly basis, they're sending that out to Brussels to help support the European Union. The other piece that we looked at that could be a positive for them, the UK is definitely a big player, kind of the gorilla of Europe. It's a very important country, and they are the financial hub of Europe, and also they are a net importer. They're less dependent on other countries than maybe some other European countries. We might be more worried if the UK was exporting the majority of its items to just solely Europe, but they're also exporting to the US, and that is actually a good thing, that they have a broad trade network, which is really important for them. Now, other things that could have an impact long term is potentially Northern Ireland and Scotland hinting at independence. Again, this is far down the line, but something that I think was really interesting, as you see here, Northern Ireland, 55.7% of the voters there voted to stay in the Union. You saw for Scotland here, Scotland actually had even a greater turnout for staying within the Union. About 62% of all individuals wanted very much to stay within the Union. So this is a story that we do need to kind of keep our ear to the ground to see what this looks like, and the coming weeks, the coming months and quarters will really, I think, be very telling to see whether or not they have any type of second referendum to trigger them looking to possibly rejoin the EU and potentially leave United Kingdom. So a lot going on, particularly with the economy, and again, just in sum, what we're looking at is a long-term impact to the European community as well as to the UK. I think what's interesting is the studies do give some conflicting advice. There are definitely some, positives that are being put forward, and wonderful studies backing up those statistics. But we're also seeing some negative and concern about what this means. And essentially, they're talking about when we're looking at 2030, when the full impact of this is expected to be felt. At that point, possibly having GDP reduced by 3% at that time, and a few studies that we read all even expect that it might be increased by 2%. So a lot we're going to have to see based on the real numbers and how this plays out. There's some positive, as I mentioned, but overall, when we look at this, it's going to be more of an uphill battle for Europe and the UK. So let's talk about investment outlook and positioning. So this is something we always like to go out and look at. This is our positioning for the next 5 years and the expected annual return. These actually have not changed significantly since over the last even few days. But you can see where we are at. We're at a base case scenario. That base case scenario is expecting returns of about 4% from U.S. stocks, Europe 13%, and that would be from our lows that we see today. Emerging markets at 11%. I'll skip down to our bonds here. Plain vanilla, high-grade investment-grade bonds, not really too exciting there. But we do expect some nice returns from your holdings of high-yield bonds as well as your floating rate loans. So that's really definitely a bright spot. Now, we've also included here our bull case scenario. So if we have a recovery that is more hurried and more robust than we're seeing now, you can see that all these numbers for pretty much all the asset classes overall, there's definitely a reason to party there. That would be definitely bringing out your champagne and your party hats. Now, what happens if we have a bear scenario? And that bear scenario would be, moving back to very negative returns and results for the economy. Here, we would be actually looking at some potential losses from U.S. equities, some U.S. stock loss. Europe lost there. Emerging markets only flat, unfortunately. And then here in bonds, the only star performers in bonds would really be those floating rate loans that we have a nice position in. As far as, what does this mean for you? What's important for your portfolio? Well, it's important that your portfolio has a few different pieces. It's number one, you want to make sure that you have the proper mix of stocks and bonds. That is the most important fundamental piece. And your mix of stocks and bonds is probably going to be different than everybody else on this webinar. Every person is different, and their goals are also unique. Due to your life events, market movements, making sure that you're able to shift your portfolio when it's needed. And we wanted to say right now, a shift in your portfolio right now is not something that we would recommend. We think of investing in particularly the stock market for long-term investors, that we only make significant changes in the mix of stocks to bonds when their life changes. So maybe they need their money sooner, they're going to be retiring earlier. Could be that they have become less comfortable with risk for some reason. And that's where we have that bigger conversation, because we want to make sure that whatever allocation that we create for you, that's an allocation that you feel comfortable with in good times as well as in bad times like we're feeling right now. It's also really important that buying low, that selling high, to move you back to your proper mix of investments. So a great example of doing that, we're actually going in, and any clients that had cash on hand, we're going in and we're making some really nice purchases, and we're buying some fantastic quality investments for ultimately bargain low prices. There's a couple success tips, and number one, not acting on impulse. It's really hard right now. And here's an example. This is the crash. This is not from today. This was actually from 1987, so from a long time ago, saying that the world is going to be different. Well, guess what? We're in that world now, and it's really no different. So something that I really want to tell you to be careful of, it will cut down on the amount of Alka-Seltzer that you have to have, is really reducing the amount that you're watching in the media, because the media, they definitely tend to be scaremongers and something that was just not going to be good for you. A lot of people are swayed by the media to actually make changes in their portfolio. Again, just want to remind you that they're out there to sell newspapers. They're out there to get you to buy, watch, whatever it is that really fuels their ad dollars is what they're really concerned about. So focus on what you can control. Working with an advisor is a great thing to do because it does help just knowing that you have a team player. Things that you should need to do is do tax-efficient investing. You can essentially have returns of anywhere 1 to 2% higher every single year if you're smart about putting tax-inefficient investments like bonds in your retirement and tax-efficient investments like stocks in your non-retirement. Investing in a low-cost way, again, low cost that doesn't drag down your performance. Diversifying, very important that you have both stocks and bonds, both here in the U.S. and internationally, and staying disciplined. Staying disciplined, making sure that you're staying the course with the market. So I wanted to give you a couple quotes that just came out today, really focusing on what we can control. So Brian Belsky is actually the Chief Investment Strategist for BMO Capital Markets, came out that said, "We believe any Brexit-related weakness should be viewed with an excellent buying opportunity, particularly considering trends are a bit better." Ron Lieber, who's a financial guru and to be honest, a hero of mine, he writes for the New York Times, came out and wrote this article this morning saying to people like you, take some deep breaths and don't do a thing. Stocks are most useful for long-term goals. So unless these goals have changed in the last day or two, which to be honest, may have changed for some of the people living and working in Europe, it doesn't make sense to overhaul your investment strategy based on a blip in a market activity. And even Jim Cramer, and I don't know if you've seen Jim Cramer, but he's the bane of my existence because he blows everything out of proportion. And he was quoted saying that the markets are blowing this out of proportion, which is, I feel like the first for Jim Cramer actually going on the more conservative side. So I wanted to share this with you. This is an interesting chart that shows individuals who added $2,000 to their investments every time the market dropped 8%. And then we have a group of people that every time the market dropped 8%, they moved $2,000 from their stocks to bonds, a more conservative route. So they started off with the same amount of money here. You can see back in 1975. Those that took money out of bonds every time there was a drop, you can see only ended up with about $400,000. Those that used those drops, quite understandably, pretty scary. A drop of 8% or more in a month is really a significant drop. But they use that as an opportunity to get more of their money working for them. And you can see that they ended up with essentially almost 2.5 times more money as a result with 1.1 million, which is great. That's what we, to be honest, that's what we all want. So let's take a look at this. These are actually what happened more recently, including up to 2015, all the way back to 1928. And it looks at what is the performance of the S&P 500 after different corrections. And we used what happened to that market 6 months after a 10% correction. Well, it went up 22%. 12 months after a 10% correction, it had an increase of 24%. 6 months after a 20% correction, even at a greater loss there, it went up 27%. And 12 months after a 20% correction, it blew through the ceiling at a 40% return. So we just want to show you this again, that after a large correction, again, this is what we're seeing right now. We often find that the recoveries are quite significant and steep. And you want to make sure that you're in the market. And what you're going to be battling is your lizard brain. So this is your amygdala right here. That little tiny area is 100% responsible for that fear that you see or you feel when you see something on the TV, like today, where you look at your portfolio and your portfolio is going down. That amygdala is your lizard brain. And that lizard brain essentially is that flight and fear brain, so that when the lion comes and tries to eat you, you feel that fear and you run the other way. Well, it can definitely save your life, particularly if you're out in the jungle. However, when you're in the investment jungle, it doesn't always help. And here's a great example. Part of that amygdala, you'll see, is that your pain threshold of a $50 loss is so much more significant than a $50 gain. So that means when you see a $50 gain in your investment portfolio, the pleasure that you get from that is only, well, just a tiny bit. But however, look at this unbelievable amount of pain from a $50 loss. It's almost 4 times as extreme. And what's driving it? Well, it's definitely our lizard brain. And that lizard brain causes us to do some not so great things. It causes us to buy a lot of stocks when the market's doing great, and then selling when the market's not doing so great like now. And I have to tell you, this is a wonderful thing to do until you repeat and you're broke. So what we're saying is don't turn a temporary decline into a permanent loss. And here are the things to think about, what I call gains. Gyrations in the market are normal. Allocation, your mix and stocks of bonds are key. You're investing for the long term, not necessarily for tomorrow. And if you need your money in the next several years, well, I have to tell you, you're making a big mistake. Your money should not be invested in the stock market. Never let emotions drive your decisions, because your emotions are being fueled by that lizard brain. And savings is what you can control. Savings is most important. This lizard brain, can I tell you, it's going to hurt you if you don't recognize it and put it in its place. Betterment put together a listing of a total of 7 different studies, and these organizations and researchers looked at what is the performance of the average investor versus someone that would be working with an advisor. And you can see that the performance for that average investor on their own is significantly less. Dalbar had performance of more than 4.3% less each year. Cash, it was about 1%. Friesman, 1.5%, about 2%, 1.6%. Barber, and then we have another one right here. Now this I wanted to show you, which is really key. So this dotted line shows you what are the pull on performance for the people who are what's called day traders. And I don't know about you, but day traders scare me. But I feel like they must know something that all of us don't know, right? That's what they spend their day doing, is trading their accounts. So they must have some information that I don't have. Well, can I tell you, despite the unbelievable conversation and the great stories that they tell at cocktail parties, day traders on average underperform those working with investment advisors by more than 6.5% each year. So I think this is a really wonderful chart that kind of puts it all in place. So when times get scary, remember, because your money today is going to buy less in the future. By not investing in the market, you're actually taking risk. Not investing means you're taking risk too. And be fearful when other people are greedy. That means when, like the late 90s, when you see that internet bubble and people are buying like you wouldn't believe and being greedy and the market's at an all-time high, be fearful then. But be greedy when others are fearful, like now, when the market's down, when there's a lot of fear. And you can see that. You can see that in the market. You saw that massive drop, almost a 500-point drop in the Dow this morning when we started off. And then the market is starting to recover. It's that fear, it's that uncertainty. And don't let yourself be subject to it and make bad decisions with your portfolio that you're just not going to be able to recover from. So we know you have questions. We know you have questions. We already sent out an email with more of this information listed, but we're here, and we're here all day. So please call us with your questions. You have also our email, info@francisfinancial.com. You can email me directly to Stacy, STACY, @francisfinancial.com. You have our office number there, 212-374-9008. We are here for you, and know that this is definitely something that we should focus on, but it's not something that you have to worry about if you're a long-term investor. Thank you for your confidence. Thank you for your support, and we're here for you, so give us a call.